Hi, I'm Reid Cramer. I direct our asset building program here at the New America Foundation, and I'm here with Mike Konczal, who's a fellow at the Roosevelt Institute and a blogger and writer online. And Rory Baum is his blog, and he's been a commentator on the financial reform debate. And we sit here as the Dodd-Frank financial reform bill is soon to be signed into law. And I wanted to get Mike's sense about how this is going to change the world. What's it going to look like differently once this bill becomes a law in a couple of years from now? And what's at stake?
Okay. Well, the stake is a huge part of our economy. The financial sector touches every part of our lives, from our home mortgages to the way we finance our businesses to the way we hope to grow employment in the 21st century. So it's very important to get this right. We usually only look at financial reform every 20 years or so. And the better job we do now, the less we have to worry about in the future.
So it's often been described as the largest overhaul of the financial sector since the Great Depression. True, false, none of the above?
I'd go none of the above. It's certainly the most comprehensive. It touches on a lot of things, ranging from derivatives to the ratings agencies to consumer finance to the largest financial firms in the country. So there have been other really massive bills in the 50s and 70s and 80s, but this one is certainly one of the more comprehensive ones.
Yeah, we've done a lot of thinking about how some of the problems on Main Street have connected to the problems on Wall Street. But looking just at the finance side of things, in the past, we used Wall Street to allocate capital efficiently so that it would fund efforts that could help the economy grow. It seems like we've gotten away from that in recent years, to say the least. Can we get back to that? Does this bill help us move forward in a more productive way? Does it set the conditions for that kind of change?
That's going to be a tough question. A lot of this bill is how it's implemented through regulators, how follow-up studies and follow-up portions of it work, and how the international community reacts to it. Some of the things we do see is that it will be harder for firms to bet against bad decisions that other people make. So we saw a lot of problems with firms like Magnetar is that they would create debt for the purpose of betting against it. And that's a huge... We want people to bet against bad ideas, certainly, but we certainly don't want people to purposely design something to fail. I mean, if you purposely set your house on fire to collect insurance, we would think you're a very bad person. But when the financial sector does it, they're gravely rewarded. So trying to make sure derivatives clear and have good price transparency with derivatives is one way that will help with that.
Yeah. Well, I just finished reading The Big Short, and in it, Michael Lewis does a great job of kind of explaining how exactly this. These securities were created. People, really for themselves. They justified themselves just by the process of creation. Money was made, and really little value was created for the economy as a whole. Can we move away from that model? And what else? What has to happen for us to do that?
A lot of that has to do with the incentives that agents face in financial firms. Right. So if you make enough money to walk away from the firm every year and you're not really worried about 10 years from now what your bosses or your investors think of you, it's very easy to make decisions that aren't good for the firm. And, a lot of these firms are publicly traded, so you do have responsibilities, but it's very easy for a lot of firms to walk away from them. So that is not going to be touched in this bill, and that's going to have to either be a market solution or a cultural change, or some people might have to go to jail. Or
Well, it appears that we're not getting as much of the perp walks as we might have expected, but I just am interested in whether we're going to get some of the other changes. I want you to talk a little bit about, I know you've written about some of the work with the rating agencies, and also what are some of the basis of action that this new Council of Financial Oversight could take that could change the rules of the game for firms on Wall Street?
Well, a big problem we had before is that banks didn't have counter-cyclical capital. To explain that better, they decided to not hold a lot of money when the crisis was building up, and now they're stuck with too much money right now. So one of the big problems we saw, to back up a second, is that the SEC in 2004 let the 5 biggest investment banks go to 30-to-1 leverage. They required them to hold much less capital, and it made them much more risky to any kind of financial crisis. That's exactly the worst time to do that, 2004, and that's, of course, exactly when they had the most pressure to do that. So though there aren't hard leverage caps in this bill, which I think is very unfortunate, and many other expert commentators think that that's a huge problem, the Risk Council does have the ability to do that, and it does have the ability to have liquidity liquidity requirements. So a lot of these really big and really risky firms were essentially funding themselves with overnight loans, almost like paying your entire life on a credit card. And when those rates jacked up, they collapsed immediately. That's what we saw with Lehman Brothers. So they can also capitalize against that, though they're going to kick it to Basel. So a lot of this bill puts a lot of trust in regulators.
Right. So they're going to kick it to Basel. Basel's going to come out with some global standards for capital requirements, and then we'll see our council setting out marching orders to the firms that are operating here, saying this is the new kind of terms of the game, and get in line. Is that kind of the
in an
flow?
ideal world? In an ideal world, that is what will happen. Now, Basel III, for instance, has a rule that they're calling the Bear Stearns rule, which is hopefully you haven't forgotten already. Is Bear Stearns is a firm that collapsed and we had to bail him out. So. There's a rule now, of course, it's being lobbied against by every financial institution in the world because no one wants to have that rule. And, there's not a lot of pressure on the opposite side. We're trying to write about it and try to get people informed and engaged. But in general, there's a lot of, the deck's very much stacked against real reform in this area. So we're cautiously optimistic about what the bill can do.
And when does this gathering happen, the international gathering of financiers?
It's been ongoing. They've put out their initial papers. They took comments on it, which was the lobbying effort.
Right.
And they'll be continuing to discuss it for the rest of the year. So
into the fall and winter. So, all right, well, we'll stay tuned. We'll have you back, get your thoughts on how that process unfolds. And following this process of financial reform into next year, hopefully we can look at some productive changes in our economic system and get your thoughts on that as it unfolds.
Thank you very much.
Thank you, Mike.